Hi there. Thanks for tuning in. Today, we're going to be doing an updated analysis and valuation of Crocs. So, I want to just get started and let's talk about why I'm doing an update. So, recently in their third quarter of 2024, they reported earnings, their revenues are up, Crocs brand revenues are up. However, as I've highlighted, Hey Dude is down. So, in general, Hey Dude was this very big acquisition that they made. They were basically saying, "We're buying Hey Dude. It's a growing brand that's going to further our growth, and it's going to be another very important part of our company," which kind of backfired in a way. I mean, it's not like Hey Dude is irrelevant now. It's not like people aren't buying Hey Dude, but of course, Hey Dude shoes aren't growing the way Crocs is, which is very interesting. And it's very interesting also because it shows the resilience of the Crocs brand itself. Some people hate them, but people keep buying them, of course. So at the end of the day, they have an acquisition that isn't doing as great as expected, but at the same time, is it realistic to think, hey, they went down 17% in terms of growth for Hey Dude? This will continue going on? Well, probably not. But investors did not love this. So that's just how it goes. That's what happened. And Crocs got punished for it, as we'll see. However, their sources of growth here are 20% Hey Dude and 80% Crocs. It's wholesale 51%, direct to consumer 49%, and they're probably even gonna grow that direct to consumer a little more. But so far, so good. I mean, if Crocs is 80%, then Hey Dude not doing as great as anticipated isn't that big of a deal. And then geographically, they sell 56% of their shoes in North America and 44% of their shoes internationally. So some geographic diversification there, which we like to see. Then we look at gross margins. In general, their margins are monstrous. They are amazing. And the Crocs brand margins are better. Hey Dude margins are better. So in general, even though you see the Hey Dude growth slowing down, well, margin improvement means that once it does speed back up, you're in a pretty good position there, you know? And even they can show that a growing brand can also have growing margins in general with the Crocs margin improving. Their inventory also has decreased. This is a pretty good thing. The less inventory you have, the less you have to sell things at a discount, the less you have to get rid of things for less than they're worth. So, this was a big problem that plagued basically every retail company to some extent around 2022, 2023. This is something that they seem to be dealing with just fine. Now, how are they allocating capital? They're basically saying that they're going to invest in their brand growth. So 2024 is an investment year. They are going to pay down their debt, which, yeah, they paid $110 million of debt, which is awesome. Total borrowings are 1.4 billion. It's a little less if you add the cash that they have in hand. And then they're returning capital to shareholders by repurchasing shares. They repurchased 1.1 million shares and have way more available. So, yeah, debt repayment and buying back shares. And if you've seen any other of my analyses, well, this is something that directly increases the value of the company. If they have less debt, they have more cash available in the future to do different things, of course. If they buy back shares, your shares as an owner are worth more. So this is very important to me. I liked seeing this, of course. And if we look at the long picture still, Crocs revenue growth is monstrous. It's just insane. And so are their margins. Once again, their margins, their gross margin, their operating margin, even their free cash flow margins, which sit around 16%, and also the return on invested capital also being in those double digits. Incredible numbers. So I'm not too worried about Crocs, even if they have a tough year. I mean, they had a year of contraction around 2015 and 2017, and yet they came back stronger for it. So I have no doubts that they'll be a-okay. And I am going to factor in my models some shorter growth rates, smaller growth rates. But even then, I believe they'll be resilient because of these insane margins, you know? So the revenue estimates here, I'm going to go to Yahoo Finance, go to the analysis tab, and see that 12 analysts have revenue estimates for it. They're pretty closely tight in 2024, so between 4.07 and 4.08 billion dollars for 2024. And then in the next year, there's going to be a little bit of growth. So I'm just going to take the lower band of these revenue estimates to be conservative. I'm going to say 16% of that revenue turns to free cash flow. And then I'm going to grow it in 2026 and 2027 by 5% and then by 3% in perpetuity. Now, my required rate of return for Crocs is going to be 11%. This is 1% more per year than the market on average. And my perpetual growth rate, as I said, 3%. Divide that by the total number of shares out, and I get a value for Crocs, fair value of equity, of $142.50. However, if you adjust for the net debt that they have, then the value post debt would be around $115.26. So that's what our model is giving us with these assumptions that are, I think, a little conservative, a little timid, and on the lower band of revenue estimates. I'm doing this just to be preventative, just to not be surprised. Let's compare it to the current price. Wow. So as you'll see here, this is actually lower than my model is giving me. And the last time I analyzed it, it was around this level. It was a little lower than 100. It shot back to 150. Now it cratered back down to around 100. So as you'll see, this stock has points where you would buy, points where you could maybe consider selling, and points where you would totally buy back. If it goes back to these levels where it's around 80 bucks, I would load up on this and I wouldn't think of it twice, honestly. It's too good of an opportunity. The P ratio is 7. I mean, that's pretty insane actually. And the market cap is 6 billion, which is not that much, honestly, considering the fact that they make quite a bit in revenue. So, you know, in general, this model is looking good compared to this, of course, but the reasons why are because valuation is reasonable even with very timid growth assumptions, share buybacks and debt reduction, which they have less shares and less debt compared to last time I valued them. So that's great because they keep generating value. The margins are still insanely good. And even though, of course, the big risk here is tariffs and inflation and possible recession, that would affect Crocs like it would affect any retail place. They mainly manufacture their shoes in Vietnam, which isn't as affected by tariffs, but China and Mexico, which potentially would be. Then that is something you will have to decide. How much can you tolerate this? How much can you put up with that as a factor of risk? But I think at the end of the day, because they have such good margins, they can take that hit. They can find ways. I mean, companies will do just that. So even if they don't do amazing, the numbers are just too good to ignore for me. So I would say it looks especially good if you are willing to tolerate these tariff risks that are incoming. And I just think it's a company that got punished a little too much for Hey Dude when the Crocs brand itself is very resilient. And I do think Hey Dude will grow eventually, right? So if you agree with these assumptions, I think Crocs looks very interesting in general. So find constant value generation. I mean, find companies that are consistently growing, that are consistently either buying back shares, giving you a dividend, paying down debt, or have no debt, so they can give value back to shareholders. And I think Crocs is doing many of these principles well. So I think this is something that you should keep in mind every time you look at a company. I hope this was a good example. It doesn't have to be Crocs for you, it can be any other company, but know that it has to give you something back. Now, thank you so much for watching. I really appreciate it. If you want me to look at any other stocks, comment down below and let me know which you want me to look at. Other than that, please remember to like and subscribe. It really helps me out, and I hope you have a great rest of your day.